All right, everybody, welcome back to another deep dive with me and our investing expert.
Hey, everybody.
So today we're going to be tackling a question that's super relevant for a lot of folks out there, especially as we're thinking about the long term, about our finances, and how we set ourselves up for success. And that is, are stocks actually a smart investment?
Ooh, yeah, that's a good one.
Yeah, so this is something that a lot of people have been talking about for a long time, and we have a clip actually from the entrepreneur Anik Singal, who has a lot of experience in this space, and he makes some pretty bold claims about traditional investment vehicles, and we're going to be using that clip as a jumping off point to kind of dive deeper into this question. So let's hear what Anik has to say. So he says, I wouldn't touch a stock. I don't touch mutual funds. I don't touch ETFs. You know why? Because it only makes them rich. If you're at Rich Dad Poor Dad, it says your house is not an asset. Why? Because for 30 years, when you own that house, you're sending money to the bank, right? So when you have a 401k or a retirement plan and all this, and let's say you start at 20 and you can retire at 65 for 35 years, you're going to send that money to buy stocks, bonds, mutual funds, ETFs, and savings. Stupid. I want my assets putting money in my pocket. I don't want to buy a house that tax money for my buck. Most retirement plans aren't assets or liability because they're sucking cash out of that person's pocket for 45 years.
Wow, he did not hold back.
He did not hold back. Yeah, calling these investments stupid. It's a pretty bold statement, right?
Yeah, and I mean, for folks who are listening who maybe, are newer to investing, this might be a little jarring.
Totally.
You hear all this conventional wisdom about, putting your money in the market for the long haul.
Right.
And then you hear someone like Anik, who's obviously successful, saying, don't do that. It can be confusing.
Yeah, and I think what's really interesting is he's not just saying like, oh, I prefer a different strategy.
Yeah.
He's actually saying it's stupid. Like these are bad investments.
Right.
So I'm curious to break down what he's actually saying there. What is the core of his argument, and does it hold water?
Yeah, so I think that the key thing that he's getting at, and he uses that reference to Rich Dad, Poor Dad, which is a popular book about personal finance. The key thing he's getting at is this idea of assets versus liabilities. And he's basically saying that these traditional investments are actually more like liabilities because they take money out of your pocket.
Right.
Instead of putting money in your pocket.
So for people who maybe aren't familiar with that book or haven't thought about it in a while, can you kind of remind us, like, what's the basic definition of assets and liabilities in that context?
Yeah, so the real simple version is an asset is something that puts money in your pocket, so you own it.
Okay.
And it's generating you income. A liability is something that takes money out of your pocket every month. Think about a car payment or rent or even your mortgage that you're paying on your house. Those are all liabilities in this framework because they're costing you money.
So that brings up an interesting point because, often we hear that owning a home is a good investment. It's an asset. But he's saying that because you have that mortgage payment, because you're paying property taxes, it's actually a liability.
Well,
So is owning a home actually not a good investment?
That's where it gets nuanced because, yes, if you look at it purely from a cash flow perspective, that monthly mortgage payment is money going out.
Right.
So it is in that sense a liability. But the thing about home ownership is you're also building equity.
Right.
And over time, hopefully your home is going to appreciate in value.
Right.
So you're building that long-term wealth. And potentially if you sell the house down the line, you're going to make money on it.
But that seems like a pretty big if, right? Like we can't guarantee that housing prices are going to continue to go up.
Exactly. And that's why it's important to not just look at it from the liability lens, but also the potential asset lens.
Okay. Yeah, that makes sense.
Right. So there's that potential for appreciation. There's the fact that you're building equity, you're paying down that mortgage, and eventually you could own that home outright.
Right.
So then it truly does become an asset that's not costing you money every month. And that's where it's really interesting to look at.
And kind of like a safety net, right? Like even if you don't sell it, you have that place to live. You're not paying rent.
Exactly. You're not subject to the whims of a landlord. You have that stability of having your own place, and you can customize it. You can do what you want with it.
Totally.
So there are definitely benefits to homeownership that go beyond just the pure cash flow.
Okay, so that makes sense with the house.
Yeah.
But what about the 401k? He also said that was like a bad idea. He's putting money in for 45 years.
Right.
And I think he makes the point that like you're just handing over your money to these financial institutions, and they're the ones who are benefiting, not you.
Yeah. And it's true that there are fees associated with 401ks and other retirement accounts.
Right.
But I think the thing that he's maybe overlooking is the power of compounding.
Okay. Yeah, that's something I wanted to ask you about because he didn't mention compounding at all. So
Oh.
how does that play into this?
Yeah, so compounding is basically the idea that when you invest your money, the returns you earn on that money also then earn returns.
Okay.
So it's like your money is making money and then that money is making money.
Right.
And it creates the snowball effect over time.
Okay.
And the longer your money is invested, the more powerful that compounding becomes.
So even though you're contributing over a long period of time,
Yeah.
the argument is that that's actually a good thing because the earlier you start, the more time it has to compound.
Exactly. And that's why you always hear that advice of like, start investing early, even if it's a small amount,
Right.
because that time in the market is so valuable.
Got it.
And that's something that I think he's not really factoring in.
It seems like, and maybe I'm wrong here, but it seems like he's coming at it more from an entrepreneurial standpoint, like
Yeah.
where you're actively involved in building something and generating that income.
Absolutely. I think his perspective is very much shaped by his experience as an entrepreneur and, the types of investments that he's made that have been successful for him, which are things that generate that active income, like a
Right.
business or real estate or online courses, things that are putting money in his pocket right now.
So do you think that kind of approach is feasible or even desirable for everyone? Because I mean, not everyone wants to be an entrepreneur. Not everyone has the risk tolerance for that.
Right. And that's the key point is there's no one size fits all approach to investing.
Okay.
And I think Onyx's approach can be very successful, but it does require a certain mindset.
Right.
It requires a willingness to take risks. It requires a lot of time and effort and energy.
Yeah.
And that's not something that everyone is either capable of or wants to do.
Right.
Right. And there's also like a whole other like emotional component to it, right? Like some people are just more risk averse. They don't want that kind of like stress in their life.
Exactly. And that's why it's so important to understand your own financial goals and your own risk tolerance before you make any investment decisions.
Right.
Because what works for one person might be a disaster for someone else.
Totally. And it sounds like what he's talking about is much more like active investing, right? Like you're
Yeah.
you're actively involved in managing your money and making these decisions, whereas something like a 401k or investing in index funds is much more passive. You're kind of setting it and forgetting it.
Right. And there are definitely pros and cons to both approaches.
Okay.
Active investing gives you more control. You can potentially make higher returns, but it also requires a lot more time and knowledge and effort.
Right.
Passive investing is more hands-off. It's typically lower risk, but you also might not see those big gains that you could get from active investing. So it's really about figuring out what's right for you, what aligns with your goals and your personality.
Exactly.
So as we wrap up this deep dive, I'm just curious, like what's the big takeaway for our listeners? What should they be thinking about as they're considering these different investment options?
I think the biggest takeaway is to do your own research. Don't just take anyone's word for it, whether it's Anik Singal or anyone else giving financial advice.
Right.
Understand the principles behind different approaches, weigh the potential risks and rewards,
Yeah.
and most importantly, figure out what makes sense for your financial goals and your lifestyle.
I love that. Yeah, and I think that's a great point to end on because it's not about finding the one right answer. It's about finding the answer that's right for you.
Exactly.
Awesome. Well, thanks so much for joining us for another deep dive. We'll catch you all next time.
See ya.